Hey, welcome to the Explainer. Today, we're diving into a super simple, data-backed philosophy for building wealth from Nick Maggiulli's book, Just Keep Buying. It's really just a single mantra designed to replace all that financial anxiety with a clear, doable plan. So, to really get the power of this idea, we've got to start with a story. It's about the author's grandfather. He was a gambler. Now, he had a steady retirement income, over 2 grand a month, with almost no living expenses. But when he passed away, he had absolutely nothing. The author did the math and realized that if his grandfather had just invested half of that money, even while gambling the other half away, he would have died a millionaire. Yeah, it's a tough story, but it perfectly sets the stage for the simple, three-word idea that could have changed everything for him. The first word is just, and that speaks to how simple the action needs to be. It's all about cutting through the noise and the hesitation. And the second word? Keep. This is all about consistency. It's not about making one big move, it's about building a habit that you just don't break. And the third word, buying, is the real engine behind it all. It's that continuous act of acquiring assets. Put them all together, and you get the mantra, just keep buying. Now, this is way more than just a catchy phrase. It's a really powerful investment strategy. You might know the formal term for it, dollar cost averaging, but just keep buying has that psychological push built right in. The idea is to make investing a regular, non-negotiable habit, just like paying your rent or buying groceries, no matter what the market is up to. All right, so here's what we're going to cover today. We'll start with where to focus your energy, then we'll get into how much to save, how to spend your money smarter, and finally, we'll tackle those huge financial decisions like debt and buying a house. All right, let's kick things off with a really fundamental question. Should you be focusing on saving more money or trying to optimize your investments? Well, it turns out the answer completely depends on where you are in your financial journey. The author tells this great story about himself when he was 23 with only about $1,000 in his retirement account. He'd spend hours and hours agonizing over his investment choices, but then he'd go out and drop $100 on a single night out without a second thought. A 10% return on his portfolio for the whole year was only $100, the same amount he'd spend on one night of fun. His focus was just completely in the wrong place. And this gets to a really crucial point. Saving is for the poor, and investing is for the rich. Now hold on, that's not meant to be taken literally. What it means is that when you're just starting out, you are financially poor compared to your future self. Your ability to save new money is so much more impactful than any investment returns you could possibly make. But as you build wealth, that whole dynamic flips. Okay, so this is super cool. It gives you a simple little test to figure out where your focus should be right now. First, figure out what you can realistically save over the next year. Let's say it's $1,000 a month, so $12,000. Next, estimate your investment growth. If you've got a $10,000 portfolio and you expect a 10% return, that's $1,000. Well, in that case, your savings potential is 12 times bigger than your investment growth. Your focus? It should be 100% on saving. And check this out. This chart just lays it all out so perfectly over a 40-year career. You can see that in the beginning, almost all your wealth growth comes from what you save. But as your portfolio gets bigger and bigger, the returns from your investments start to take over. And eventually, they just dwarf what you're able to put in each year. Okay, so we know where to put our energy. Now let's talk about how much we should be saving. You've probably heard that old rule, save 20% of your income, but as we're about to see, the data says that's some pretty flawed advice. And to really get why, we're going to take a little trip to Alaska, of all places, to meet a fish called the Dolly Varden char. See, this fish lives in a world of extreme feast and famine. Most of the year, there's hardly any food. But then, for a short time, the salmon show up, and there are eggs everywhere to eat. So how on earth does it survive? Well, it's through this incredible concept called phenotypic plasticity. When food is scarce, the fish literally shrinks its digestive system to save energy. But when the feast begins, its gut grows to twice its normal size so it can take full advantage. It literally changes its body to match its environment. And that brings up a huge question for us. If nature is all about adapting to changing conditions, why on earth do we try to apply these rigid, one-size-fits-all rules to our money when our financial lives are constantly changing? See, these save 20% rules just don't work. And it's because they miss two huge things. First, our incomes are not stable. They go up and down. And second, and this is the big one, how much we can save depends massively on how much we earn. I mean, look at this data. It's just staggering. The bottom 20% of earners, on average, they only save about 1% of their income. The top 20% save 24%. And the top 1%, they save over half of what they make. Telling someone in that bottom group to just save 20% isn't just unhelpful, it's literally impossible. So what's the takeaway here? It's to throw out that rigid rule and replace it with something way more realistic and, honestly, kinder to yourself. Save what you can. This idea adapts with you. When you're making more, you save more. When things are tight, you save less. It's about making steady progress, not beating yourself up over some arbitrary number. Okay, so you want to increase how much you can save, right? The common advice is always cut your lattes, but the data shows that's just, well, it's looking in the completely wrong place. Think about it like this. You've got two levers you can pull to save more money. You can cut your spending, or you can increase your income. Now, cutting your spending has a hard floor. There's only so much you can cut. But increasing your income, the ceiling on that is basically limitless. And this is exactly why that just cut back advice is so frustrating for so many people. This chart shows that for the lowest 20% of earners, what they spend on just the basics, food, housing, healthcare, and transportation, already eats up more than 100% of their after-tax income. There's literally nothing left to cut. Which leads us to what might just be the biggest lie in all of personal finance. And here it is. The idea that you can get rich just by cutting your spending. For the vast majority of people, you just can't frugal your way to wealth. The real problem isn't the daily coffee, it's not having enough income in the first place. So a much more powerful strategy is to focus on the other side of the coin, increasing your income. This is your action plan. It outlines 5 proven ways to turn your skills and your knowledge into actual financial capital. Whether it's freelancing, teaching, creating a product, or just climbing that corporate ladder, the goal is to grow what you can earn. But here's the really important part. Earning more money isn't the final goal. The real goal is ownership. You know, the richest player in NFL history wasn't a star quarterback. It was a guy named Jerry Richardson. He used his football salary to buy fast food franchises, and then eventually he bought the Carolina Panthers NFL team. He turned his labor into assets that made money for him. That's the real path. All right, so we're saving what we can, we're trying to grow our income, but what about spending? How do we actually enjoy the money we work so hard for without all that nagging guilt? You know, so much financial advice is built on making you feel guilty. It's like every dollar you spend has to be second-guessed, and it just creates so much anxiety. What you really need is a simple framework that lets you spend with confidence. So here's a brilliant little framework to try. It's called the 2-by rule. It's so simple. If you want to splurge on, say, a $400 pair of shoes, you first have to invest $400. This rule is genius because it does 2 things. It makes you pause and think, do I really want this? And if you do, the guilt is gone because you know you just took care of your future self too. And the second rule is for something we all hope for, a raise. That temptation to let your spending grow right along with your income, what they call lifestyle creep, it is so powerful. So here's a simple rule to manage it. Save 50% of every single raise you get from now on. And see, this 50% rule is just the perfect balance, right? Half of that extra money goes to your future self, which speeds up your wealth building. And the other half goes to your present self, so you get to enjoy the rewards of your hard work. You get to upgrade your life a little without pushing your long-term goals further away. Okay, for our last section, let's use the same clear, data-driven thinking to tackle 2 of the absolute biggest financial decisions you'll probably ever make: dealing with debt and buying a home. We hear it all the time, right? Debt is bad, avoid it at all costs. But the reality is, it's a bit more complicated than that. Debt isn't automatically good or bad. It's a tool. And just like any tool, what matters is how you use it. Debt is a tool. And there are really 2 smart reasons you might use that tool. The first is to actually reduce your risk. A 30-year fixed mortgage, for example, gets rid of the risk that your housing costs will keep rising forever. And the second reason is to get a return that's bigger than what the debt costs you. The best example being a student loan for a degree that's going to boost your earnings for the rest of your life. And that leads us right into the big one: renting versus buying a home. The best way to think about this is as a trade-off of risk over time. When you rent, you have lower short-term risk, no huge repair bills popping up, but you have higher long-term risk. Your rent can go up forever. Buying a home? It's the exact opposite. So really, the question for most of us isn't if you should buy a home, but when is the right time to do it. Since owning a home is the main way most people build wealth, getting the timing right is everything. Okay, so here it is, your final action plan. A simple 3-point checklist to know when it's the right time to buy. Number 1, you plan on staying in one place for at least 10 years. Number 2, your life feels stable, both personally and professionally. And number 3, you can actually afford it, which means you could put 20% down even if you decide not to. If you can't check all 3 of those boxes, renting is probably the smarter move for right now. All right, let's wrap this all up. The Just Keep Buying philosophy is all about swapping financial stress for a simple data-backed plan. You build wealth by consistently buying assets. You focus on saving when you're starting out and shift to investing as you grow. You prioritize earning more over pinching pennies. You use simple rules to spend money without feeling guilty. And you make those huge life decisions with a clear long-term perspective. So I'll leave you with one final thought to chew on. You don't have to do all of this at once. Just think about this. If you picked just one of these ideas to start today, the save what you can rule, the 2-buy rule for a splurge, or the 50% rule for your next raise, how would that one single change transform the way you think about your money?